Hello, everyone, and thank you for joining today's webcast on COVID-19 and municipal bond market volatility. My name is Hank Kim, and I'm the Executive Director of NCPERS. Today's program is part of our expanded Center for Online Learning. As we all adjust to the new COVID reality, please bear with us as if there should be any technical issues or unplanned background noise during our session. As always, your patience and understanding is appreciated. We encourage audience participation. Please submit questions by using the GoToWebinar portal. However, to ensure that we can cover all our topics today, we will hold your questions till the last part of the program. Additionally, in the handout section, you'll find a PDF of today's presentation. Today's webcast is sponsored by Segal Marco Advisors, one of the nation's largest US-based independent investment consultants. They provide independent expert advice to over 900 institutional clients whose assets total over $550 billion. Segal Marco Advisors delivers a broad range of investment consulting services to public retirement systems, including asset allocation modeling, investment policy development, investment manager search and selection, performance and risk assessment, corporate governance and proxy voting, and ESG integration. Their senior professionals include public sector experts who possess experience serving as chief investment officers, executive directors, risk managers and regulators, as well as in developing investment policies and coordinating with actuaries to develop integrated asset allocation programs for their clients. Examples of their commitment to public plans include the development of the model proxy voting guidelines and co-authoring NCPERS best governance practices for state and local government retirement systems. Joining us from Segal Marco Advisors are Julian Regan. He is Senior Vice President and Public Sector Market Leader at Segal Marco Advisors. He joined the firm in 2009 as part of its continued commitment to public and multi-employer plans. Between 2001 and 2006, Julian served as Executive Director for the New York State Deferred Compensation Board, where he ran the state's then $8 billion supplemental retirement plan and administered regulations that governed 250 local plans. Maureen O'Brien joined Segal Marco Advisors in 2011 and currently serves as Vice President, Corporate Governance Director, where she leads corporate engagement on behalf of the firm's clients and analyzes proxy voting issues. And finally, Don Sheridan is a director in Segal Marco Advisors' Chicago office. He is responsible for manager selection and asset allocation for the fixed income portfolio, which is part of the firm's fiduciary services platform. Maureen, Julian, Don, I'll turn over the webcast to you now.
Thank you very much, Hank. If we could go to the next slide, just going to tee up the introduction. During this presentation, which really is about the story of the municipal bond market and the unprecedented volatility in the market that was experienced in March due to COVID-19, the approach we're going to take is Maureen, Don, and I are going to provide some background in the market, talk a little bit about the bond markets or the municipal bond market's strong reputation for strong credit ratings and low default rates, and how all of that was temporarily set on its side during the month of March as volatility gripped the market and assets were sold off across asset classes, including municipal bonds, until the Federal Reserve Bank, the U.S. Lender of last resort, and Congress stepped in with enactment of the CARES Act, effectively supporting the market and bringing back stability. If you go to the next slide, just an executive summary about this presentation. I want to make the point that the market itself, we think about municipal bond issuers, they include many NCPERS members, state and local government entities, authorities like transit authorities, turnpike authorities, who issue debt through this market to finance delivery of critical government services, public safety, public health, education, transportation, and also, as we'll see as we get through the presentation, the municipal bond market is critical to investments in infrastructure that really form the spine of our economy. So disruption to the market that we saw in March, which resulted in dislocation of pricing and put state and local government finance officers in a tough position in trying to issue debt, was a real potential risk to our economy as well as to the functioning of our state and local governments. And the good news is that the Federal Reserve and the CARES Act helped to stabilize that market. So we're going to cover that in this presentation. We're also going to talk about what on any given day can be a number 1 or a number 2 or a number 3 issue in our newspapers, and that is the tremendous burden that COVID-19 related expenses have placed on state and local government budgets. That's part of this story as well, and that's a start of this. That's part of the story where the chapters have still yet to be written. But we'll be covering that, and I'm going to turn it over to Maureen to give us a little background on the municipal bond market.
Thanks, Julian.
Next slide, please.
The municipal bond market plays a big factor in our markets and in our economy. You can see here on the slide, nearly 500 billion in municipal securities were issued in 2019, and that came from a variety of state and local government entities, more than 50,000 of them. But perhaps the most interesting takeaway from this point is that 2/3 of infrastructure projects in the United States are funded by municipal bonds. So while it's this revenue stream, it's an important building block for our economy and our markets. Next slide, please. Here is a slide with some definitions that we'll use throughout the presentation that you can refer to as you find them helpful. Probably the two most important are that municipal bonds have a good credit rating and they have a very low default rate. So those two factors make municipal bonds a safe bet time and again. Next slide, please. When we're talking about municipal bonds, we're talking about primarily 2 categories of bonds. The first are revenue bonds, where most of the time that's coming from a project-specific effort, and then general obligation bonds. On the revenue bonds, those bonds are secured and financed by the revenue that's coming from the project. So for example, a toll road, where a bond is issued for that toll road, is going to be financed by the income from the actual tolls being paid on that road. On the general obligation side, that's financed by tax revenue. So as we're in this new environment of COVID and we've seen these shutdowns throughout the country, that has a large impact on the tax receipts that are coming into those entities that want to be issuing those bonds. Next slide, please.
Thanks, Maureen. If we look at a forecast that an industry group put together in January of 2020, as you can see on the right-hand side, some of the top issuing sectors in the municipal bond market finance critical functions. There's obviously general purpose government functions, but also education, public facilities, transportation, to name a few. And if you think about it, with COVID-19, some of these sectors are under pressure. Let's take public transit. Think about the impact that the economic shutdown has had on transit ridership. Transit ridership, of course, generates revenue for our public transit agencies, who are public debt issuers, municipal debt issuers. So again, municipal bond market sectors are critical to our economy. Some of these sectors are under pressure. That's part of the story today. And of course, that pressure came from COVID-19 and the economic shutdowns, which of course, thankfully, are starting to be eased as we speak. You can go to the next slide. If we look at the municipal bond market and compare it to the corporate bond market, Maureen gave us some terrific statistics. I don't know about you, but when I first learned about fixed income and bonds, the 2 sectors that first came to mind weren't necessarily municipal bonds, but really it was U.S. Treasury bonds issued by the federal government to finance our deficit, for example, and corporate securities issued by publicly traded companies, for example, who will issue long-term debt to finance investments in plant and equipment. But the municipal market, as Maureen pointed out, is very big in and of itself. 3.9 trillion in issuance, already stated by Maureen. But one number to key in on as we look at the volatility in the market is the so-called default rate. Default rate was defined earlier on in the glossary and the definitions. That default rate, less than 2%, according to the MSRB, the Municipal Securities Rulemaking Board, is a modest fraction of the default rate for corporate securities. And that really says everything, or says an awful lot about the stability and the dependability of payments to investors of principal and interest from municipal bond issuers, which is why this period, this sell-off we saw in March was so exceptional. Next slide, please.
Thanks, Julian. As Julian mentioned, municipal bond is a credit and should therefore be analyzed similarly to corporate credit. As with corporate credit, there is a credit quality spectrum that suggests risk levels to consider as labeled and advertised by the nationally recognized statistical rating organizations like Fitch, S&P, Moody's. As with any credit, there is a premium assigned to the bond that quantifies compensation for risk, which is reflected in the overall yield. AAA is basically suggesting that there's very little reason to question the entity's ability to service the debt and make good on its obligation to the lender at maturity. Extremely low probability of default. BBB and BB, on the other hand, will be higher yielding securities to reflect whatever nuances in the financials or collateral source are sensitive to changing conditions and potentially pose credit default risk. The breakdown in quality is illustrated in the chart on the left of this slide. Key takeaways are that the lion's share of outstanding municipal debt is very high quality paper. More than 80% is in the A-rated and above category. The muni market is characterized by high quality and low volatility of returns, which makes it appealing to many investors and is why the events in March were so shocking. Generally speaking, an emerging markets or high yield investor is conditioned to understand and persevere in that type of environment, not a retiree dependent on the income and price stability for tax, liquidity, and overall return reasons that individuals get from an allocation to munis. As we move along with the presentation, we're about to look at numbers that are completely out of the ordinary for this market. One of COVID-19's unanticipated impacts when it hit in March was wreaking havoc on the municipal bond market. Turning to the next slide. Recall that almost half of this market is supported by sources other than tax revenues. And add this to the fact that the muni bond issuance is on a trade by appointment without real consensus pricing basis. And one might be led to conclude that it should not be very different from what the 10-year default history shows in relation to the corporate bond market on this slide. It truly speaks to the conservative nature and limitations on the tax-exempt amount of issuance the muni asset class can have that work to prevent froth and reckless underwriting behavior. The almost non-existent single A defaults in munis versus 5.48% in single A corporates is eye-opening to say the least. When evaluating a municipal bond versus a corporate bond yield, the key is to determine the tax equivalent yield that the tax-exempt municipal bond offers. Otherwise, it's logical that you will always see a much more attractive higher yield and income potential on the taxable corporate side. There's another area of the muni bond market that is growing significantly of late, which is the taxable muni asset class. These securities, of course, can become.
I think we lost.
Yeah, I think we lost Don.
Side by side with the corporate bonds without any adjustment needed to conclude. I'm going to turn it back to Julian to touch on the impact COVID-19 has had to state and local budgets and how municipal debt issuance is integrated and impacted by all of this.
Thank you. I'm going to go to the next slide, slide 11.
Next slide, please.
With NCPERS members, I think many folks who may be listening, and certainly NCPERS members broadly, given what you do, given the public service you perform, I think you're well familiar with the fact NCPERS members are that state and local government spending, some of which is financed by municipal bonds, some of which is financed, of course, by tax collections, as we'll see in a little bit, is a significant contributor to the economy. If you look at the upper left-hand side of slide 11 here, you can see, according to the U.S. government, last year in 2019, state and local expenditures totaled about 2.3 trillion. That was about 11% of GDP, 11% of the size of our economy. So when we talk about getting our economy back on its feet again, putting people back to work when we have an unemployment rate of 13.3% because of the temporary government shutdowns, a big part of the solution is going to be state and local government spending, and that's integrated in this presentation. Another impressive figure, if you look in the upper right-hand side, Maureen already spoke to the fact that the role of the municipal bond market in financing infrastructure investments. But that number on the upper right-hand side, that 4.2 trillion, is an impressive number. State and local government investments in infrastructure financed by typically longer-term debt issuance, which will match the life of the investment. So a multi-decade maturity on a longer-term municipal bond has financed 4.2 trillion in infrastructure investment in this country. And that's just one more reason why it's critical that we keep the functioning of the municipal bond market on track, given that it enables all this economic activity. Next slide, please. Back to Don, we're going to talk about the volatility, I believe.
Sure, thanks, Julian. Municipal bonds sold off aggressively in March and completely decoupled from Treasury yields. 3.31% yield on a tax-exempt AAA municipal bond would put that more in line with the lower quality taxable corporate bond. There was a race to the exits in March as investors looked to the more liquid parts of their respective portfolios to withdraw funds for reallocation, rebalance, income, or cash purposes. The mechanics that govern transacting and execution in this market froze up because everyone was on one side of the trade, with $45 billion exiting the muni market mutual fund complex alone in March, as you can see in that chart to the right. If we turn to the next slide, you can see how municipal bonds and risk-free Treasury yields historically correlate very highly. The ratio of 10-year AAA rated muni yields to 10-year Treasury yields skyrocketed to 300% before the government stepped in to provide stability in the market, a complete anomaly. You can see that other areas of the municipal, or the various areas of the municipal bond asset class that got impacted differently. High yield, negative 11%, clearly got hit the worst. It's a smaller portion of the overall market, roughly 8%. But even, with the broad investment grade Barclays Municipal Index down 3.63% in March alone, is pretty much unheard of.
Don, I want to ask you a quick question, if I may.
Sure.
For the benefit, we're looking at statistics through the lens of the investor, but if you could perhaps speak to what does this type of volatility and what do these spikes in yields do to state and local governments entities' ability to raise money cost effectively?
It does definitely impact if it's prolonged. It depends on the extent of the fundamental deterioration that we're witnessing. What we're going to talk about in a little bit is sort of the government intervention that prevented a potential prolonged catastrophe from unfolding. But indeed, a lot of the market since that spike, that volatile time frame, has come back in to a more normalized condition, barring the high yield area of the market, which is still a bit dislocated and not yet corrected. But yes, there were a lot of liquidity situations that created a spike in yields and an execution malfunctioning in the markets. But there were also People are kind of looking longer term and thinking big picture with tax revenues and all of those other areas, that fund local governments and budgets that could also be impacted by a prolonged, lockdown and COVID-19 situation. So turning to the next slide, you can see who the holders of municipal bonds are. Over 70% of the market are households, mutual funds, and ETFs. More traditional, longer-term institutional players in the space, like insurance companies, they could become less pronounced going forward as sweeping corporate tax reform makes for a less appealing tax-exempt value proposition when comparing munis to other taxable credit opportunities. So we'll see what happens there, but there was, there was a lot that has transpired with corporate tax in those situations in the last few years. Now I'm going to turn things back to Julian to expand on the current state and local government budget situation, and then discuss action taken by the federal government to help backstop this essential market.
Thank you, Don. I think we're on slide 15. And one thing in relating state and local budgets to the municipal bond market, I failed to mention, going a little bit fast there at the beginning, for your typical or on average debt service on municipal debt, that is the principal and interest that the city, the county, the town, the authority, the state is paying on its outstanding debt, it's about 5% of budgets, 4 to 5%. So it's not a very large number. There are a number of technical reasons for that. That's not so much in scope for this presentation. What is in scope is the COVID-19 impact on state budgets. If you look at the last bullet on this page, slide 15, and we'll put some numbers around this momentarily, state and local governments face significant shortfalls in their budgets for the fiscal year that's ending now. For many states, your fiscal year, of course, ends on June 30th. And of course, for fiscal year, the fiscal year that starts July 1st and ends June 30th, 2021. Why is that? Of course, it's state and local government that bore the brunt of significant unbudgeted public health expenditures. And of course, as Maureen mentioned previously, due to the economic shutdown, sales tax collections, other forms of revenue that are generated by economic activity that fund state and local government budgets are severely curtailed. And a very important point to make in discussions around seeking more federal aid for state government, which is very much merited, is that the dilemma that state budget makers find themselves in many cases today was caused not by any decision that was made by state and local government. It was caused by an unprecedented public health emergency and caused by the public health community's recommendation that economies be shut down. So really an uncontrollable event has put states in a position where, as of March 26th, for the fiscal year that we were still in at that time, 14 states had enacted supplemental appropriations. We'll see some more figures here, but the bottom line is that additional federal aid is needed for the entire state and local government fiscal picture. We know again that it's employees of public entities who are bearing much of the brunt of trying to get our economy restarted. Their employers, state and local governments, need financing to undertake all the critical functions they perform. Go to the next page, page 16. Maureen,
so to put some data around the concepts that Julian was speaking about just now, over 40% of revenue from receipts that states are collecting come from income, sales, and other taxes. So that's a huge component of the budgets for these states. We saw that during the COVID, the shutdown, states have enacted that to varying degrees, but it was the recommendation of the federal government that the shutdown happen. And so the federal assistance that has come through has helped shore that up, and more is needed. We saw a similar trend in 2009 during the Great Recession, where receipts drew down at states 9%. So we're likely to see big drawdowns again during COVID. The good news is that every state has a rainy day fund. And in the Great Recession, the rainy day fund as of 2010, at that point was 1.6% of general funding, general fund spending. And in 2020, that percentage is much higher. So we're in good shape there, where it's up to 8% as of 2020. Next slide, please.
Building on Maureen's point, state governments entered this crisis in a very strong position, which gives us optimism that state and local government will reemerge in strong position. And in very much the same way, you hear economists talk about optimism about the nation's economy recovering from the economic shutdown, because the economy at large, not just state and local government, but the other 90% of the economy, entered the public health emergency at the end of February in very strong shape. So that's a point not to be lost. But if we look at the big picture impact, it can be said that state and local government tax collections and budgets are a lagging indicator of economic activity. We certainly saw that in some of the data related to the Great Recession. And here we have from the Center for Budget and Policy Priorities a projection of state and local government shortfalls for 3 fiscal years related to COVID-19. And you can see the CBPP is projecting that over 3 fiscal years, and again, fiscal year 21 starts for 46 states on July 1st. For that 3-year period, they're projecting a shortfall of over $600 billion related to those curtailed tax collections that Maureen talked about and those unbudgeted expenses. And of course, if you look at the Great Recession, we had 5 years of impact from the recession at that time, and collectively, that number was not that much higher than the projection for COVID-19. Now, if you follow the issue, and I'm sure NCPERS members do follow it closely, you'll see different projections from different entities. But the bottom line is that the federal aid that came through in the CARES Act is viewed as just an initial installment in what's ultimately going to be needed to help state and local governments address those bracketed numbers you see for fiscal years 20, 21, and 22. Next page, please. So the good news on the municipal bond market front, and just broadly, this story is really a story about government and Federal Reserve Bank intervention addressing the volatility that you saw Don speak about that made it hard for governments to borrow money. And the bottom line is the assessment of the intervention in the form of the CARES Act and in the form of actions taken by the US Federal Reserve Bank is that those interventions worked. What happened? Well, first, if you look at the left side of this page, between March 20th and March 23rd, the Federal Reserve Bank, who's been pretty busy lately, as I know people know, announced that they would start to accept short-term municipal bonds purchased from mutual funds as collateral for lending to banks through one of their lending facilities. Why did that matter? That mattered because now, with this acceptance, it made it so that banks could turn municipal bonds into cash more easily. So it made municipal bonds relatively more attractive, and that starts to push back against the spike in yields that Don was talking about and the dislocation in pricing. Next, we have the CARES Act. Of course, looking at the middle part of this page, we know that the CARES Act authorized about $2.1 trillion in different forms of relief to help us get through this period of self-mandated economic shutdown. Part of that relief was more than $450 billion authorized to backstop potential losses the Federal Reserve Bank might incur on lending directly to businesses, states, and municipalities. Also very helpful for the municipal bond market. Finally, the CARES Act appropriated over $270 billion, I'm going to get the number right, to state and local governments, as well as to healthcare, transit, and educational institutions who are issuers of municipal debt. And then finally, in April, the Fed established a so-called municipal liquidity facility, which basically was set up to enable their ability to purchase up to $500 billion in short-term notes issued by states, cities, counties, and other public entities. And if you think about it, Maureen cited at the beginning that the municipal bond market is about $3.9 trillion in assets. That $500 billion is over 10% of that value, if I'm doing my math right. So that's a significant number, and it's a number that affected, as we'll see on the next page, I'm going to go to page 19 here, a number of municipalities, making it easier for them to borrow money, but also very importantly, helping to stabilize investors who are concerned in the municipal bond market. So with this facility, the Fed basically started by authorizing, I should say, direct purchases of short-term municipal debt. That would be debt with maturities of 36, or ultimately debt with maturities of 36 months or less, issued by government, by cities with populations of 1 million or more, and counties with populations of 2 million or more. Subsequently, during the month of April, the Fed came out and actually broadened the eligibility. As you can see, now it's cities with populations of greater than 250,000. So medium-sized cities, my hometown of Buffalo, can participate, and counties with populations of 500,000 or more. And you can see revenue bond issuers as well as multi-state entities. You can see some of the eligibility on the right-hand side on page 19. Just one good point to make. See that last bullet. Under the terms of the Fed's liquidity facility, which they posted to their website most recently in early June, if I'm a treasurer or director of finance in state and local government, I can use funds from the Fed's purchase of my debt to manage cash flow related to decreased revenue from that resulted from COVID-19. So very important, again, that the monetary solution, in this case, the liquidity facility, is linked right back to the problem and the root cause of the problem, which is COVID-19's impact on state and local government finances. So now we're going to go to the next page, and Don is going to give us a look at the market on page 20 after all of these measures were taken in Congress and by the Fed to shore up the market.
Thanks, Julie. Yeah, since the March crisis in the capital markets, animal spirits have really come back to the fold. The federal government, in coordination with the central bank, was incredibly crucial to change the psyche. And what you see here is a term structure for the municipal bond yield curve that is far more normal and palatable for outside investors to consider. It's truly a remarkable thing that the Fed and the federal government are doing in coordination. The Fed balance sheet is now, I believe, 8 trillion. They threw trillions back in 2008 to save the banks and the housing market. And this time around, they're trying to save even a wider swath of markets in need, from corporates to municipals, all over the place. But they're taking drastic measures, and it has had a meaningful impact on valuations. And today we find ourselves kind of returning back to a normal environment, and nobody has a crystal ball for the future and how long this pandemic is going to wreak havoc on our economy. But all of these markets are forward looking, and they're pricing in probably a base case overall that seems reasonable. So that's where we find ourselves today. Turning to the next slide.
Great. Well, thank you for listening to the presentation. We did want to leave you with a few key takeaways before we move to the Q&A. The first is, as Don was saying, there was dramatic action taken by the Fed and by Congress. And in this case, fiscal and monetary policy worked. It was effective up to this point. And while the debate continues on increased federal funding as we continue on in this current environment, it's important to note that it did work in this case. Also, municipal bonds, they have a reputation for being safe and stable through all economic conditions, and the actions taken by the fiscal and monetary policy helped assure that that continues to be the case.
And part of the story, thank you, Maureen, is going to continue to play out, obviously. As Maureen pointed out, the municipal bond market is in solid shape after that short period of volatility. And while the expectation from the experts, from investors, is that the municipal bond market will continue to be in good shape, there are going to be some issuers who have some challenges as a result of COVID-19, but generally speaking, the outlook is solid for municipal bond issuers. More help is needed, as we all know, for state and local budgets that fund operating expenditures. I think it's fair to say that most policymakers understand that where we are today in trying to get our economy reopened is a place where the nation is depending heavily on public servants to help restart our economy safely and efficiently, to help bring down that unemployment figure, which most recently was 13%. Police, firefighters, transit, transportation workers, educational workers, all are going to be counted on and are being counted on to go the extra distance to keep people safe in a challenging environment and to help get that economic activity up so employers can go out and hire more people and get us back to an economy that's where we were back in January of 2020. So part of the equation is additional aid coming from Washington. That's a story we'll be following closely. That's a story that investors in the markets generally are following closely. And that's really because, as we know, state and local government budgets and state and local government employees play a critical role, just as public pension funds, in driving the engine of the US economy, and are going to play a critical role in getting us back to a solid footing. So those are our remarks. We appreciate the opportunity, as always, Hank and Amanda.
Great. Thank you, Julian. Thank you, Maureen. Thank you, Don. So as we enter our Q&A session, again, please submit your questions using the GoToWebinar portal. I have two questions relative to pension obligation bonds. I don't think they, they address, they're about, the wisdom of issuing pension obligation bonds, but just generally about, if as we, go into the fiscal year, more and more state, plan sponsors are facing budgetary shortfalls, and pension obligation bonds are part of the discussion relative to financing plan sponsor contributions. To what degree would it have an impact on all the things you've mentioned today relative to the broader municipal bond market, if any?
That's a good question. I think if you think about the market generally, and I hope I'm answering the question, Hank, it's a $3.9 trillion market. So I would expect that mathematically, as much as pension obligation bond issuance on an individual issue level would be in large dollars and would have significant impact for the individual issuer. In the aggregate, I'm not sure that would have that big of an impact, just given the multi-trillion-dollar size of the overall market itself. I don't know if that answers your question in terms of the functioning of the market. And I haven't seen much in terms of the relationship between the two. But again, I think it's really a matter of dollars. 3.9 trillion. You're going to have to add an awful lot of expenditures to that, bond issuance to that, before you start to get into a discussion of a large percentage increase in bond issuance.
And then if Maureen or Don doesn't have any comments relative to that question, the second part of the question is, to what degree would it make pension obligation bonds more effective if there was legislation introduced and passed in Washington to make them tax exempt as they once were?
Don, I don't know if you want to speak to that, but if they're tax exempt, they immediately become more appealing to that big group of investors that Don alluded to, that 72% of investors, households and mutual funds who are seeking tax advantages will look at pension obligation bonds, if they are tax exempt, as relatively more attractive. So that should help pricing. If you're getting pricing that's improved on the issuance of pension obligation bonds, what does that do? As you know, that drives down yields. So that drives down the cost for the issuer. So that tax exempt status clearly would help. Don's a bit more of an expert than I am, so you might want to add something to that answer.
No, I would definitely agree with the tax exempt spin. In the taxable world, it's going to be far more heavily scrutinized. And again, to one of my points earlier about the relative merits of that versus another issuance you might be considering on the corporate side, it just might not be fundamentally what the investor wants to buy into as being underwritten to the same degree with the same collateral as maybe a corporate bond. So tax exempt would be key. I think the impact, given the opportunity set, the universe being close to 4 trillion, which is bigger than the high yield universe, very meaningful, would be, in my guess, not quite de minimis, but just marginally impactful to the overall value proposition.
Hank, if you don't mind, I wanted to add one comment.
Sure.
Back to your first question, because I want to also be very direct. The folks who analyze municipal finances, and I could say this from having been on the other side of it, working in government, interacting with them, they're cautious folks. So they're going to look at, and probably have in the past looked at, pension obligation bonds very cautiously in terms of adding to the liability. So I don't mean to give you a completely convenient answer. The fact of the matter is, that's what they do for a living. They raise tough questions, they raise tough critiques, and I would expect that would be part of what you would see coming out of those discussions. Some of those discussions have happened in the past. As we know, pension obligation bonds are not a new concept. So these debates have been had in the past, but should add that.
Okay. Great, thank you, Julian. So last question is for NCPERS members, what are the other trends in the municipal bond market space that they should be aware of that maybe you've lightly touched upon or may have not touched upon in your presentation?
Don, I'll give that one to you maybe instead of me going first.
Yeah, I mean, I mentioned the taxable universe that is growing. It's a way for municipal issuers to get around the limit that they are permitted to issue into the market. So that market began in the global financial crisis with the Build America Bonds program, and it has kind of moved into something that is I'm hearing more and more about, and it's actually creating tactical total return, even hedge fundy type opportunities from some active managers, attractive to many, and you will find the taxable world sprinkled throughout pension plans, and that not so much the tax exempt, of course, because it doesn't carry the same weight or same meaning within that type of portfolio.
And the only other point I'd add to that is we've been hearing for a number of years about infrastructure spending initiatives. I think I read recently about a multi-trillion-dollar concept that's been out there. And let's face facts, this country's infrastructure needs to be improved, and infrastructure investment creates jobs. Some of those jobs are public sector jobs, as we know. Some are private sector jobs. So being the optimist that I am, and knowing that state and local governments can cost effectively raise money to invest in infrastructure. I'd like to think that NCPERS members are going to be reading more about bond issuance to support a push to spend on infrastructure, both to get our economy going again, but also to do what we know we have to do anyway, which is to upgrade its condition. So
Great. Don, Julian, Maureen, thank you so much for your expertise today and lending us your time. And to our audience, thank you for joining us today. Please join us on Thursday for our next webinar entitled Sustainability Considerations in Pension Investments. Thank you, everyone, and have a good day.
Thank you.
Thanks
Thank
for the
you.
opportunity.